Come back to another interview, and this time we have Matthew Warder here from Seawolf Research, and it's nice to have you on here again. And can you talk a little bit about yourself, your background, what you're doing, maybe your day to day, just everything, sort of.
Sure. Yeah. I write a publication on Substack, and it's simul-published on my own website at thecoaltrader.com and thecoaltrader.substack.com. I'm primarily a coal market analyst. That's where I started my career, 20 years ago or so at Wood Mackenzie. While I was in the remit there, I'd kind of vertically integrated up through the iron ore and steel sectors as well, and built the asset level coverages for those global industries as well, before moving over to more equity type analysis and
Mm,
trying to put the fundamental research together with the finance side of things.
mm,
And so now I kind of do both, right? I'm tracking, global prices of coking and thermal coal, global, trade flows, imports and exports, and the industries that are tangential to coal as well, which would include, steel and iron ore and natural gas and power. The idea for me and for my clients is that who I consult for is that sort of broad approach will afford me a lot of information, not just about the coal industry, but also about these, tangential industries that sit
mm,
around it. We can kind of contextualize that in a global macro setting as well, because all of those industries touch not only on one another but also on geopolitics and macroeconomics as well. It provides a nice lens through which to view
mm,
global trade, and one that is grounded in realism and data as opposed to narrative.
mm.
So that's that, but that's mostly what I do. Kind of half, newsletter focused and half consulting focused.
Mhm. And before getting into sort of these, macro analysis as you touched on, I wanted to ask you sort of like, how did you get into this? Was it sort of like naturally drawn, like talking about the coal space and,
No,
like
no, no, not at all.
stumbled into it kind of, or
Oh, stumbled into it isn't even the right word. I mean,
yeah.
I'm I had a lot of interests, going through college. I went to college on a baseball scholarship,
Mhm.
and then hurt my elbow. And in the process, I was a chemistry major and I picked up a major in music, which
Mm,
I, played forever. I wound up with degrees in chemistry and jazz guitar. And then I got into medical school, but instead of becoming a doctor, my band started touring, and I was in the music
mm,
industry for 10 years. Uh, as a part of that, what they don't tell you in music school is, well, if you want to actually make a living, you usually don't make it necessarily from the music playing part. You make it from
yeah.
writing or
Yeah.
teaching or all these other things. So I wound up, teaching in the school system some, and I had a private instruction studio as well. When I was in the music industry for about 10 years, and in that last year, when I started to look at transitioning, into another career,
Mm,
one of my guitar students actually suggested that I come work with him. And he worked for a company called Hill and Associates here in Annapolis, Maryland. Um, and he wrote a study on Central Appalachian coal, which is ostensibly all of the metallurgical coal production
mm,
in the U.S. is produced in Appalachia. So, in the span of about a year and a half, I went from being a guitar player and
mm,
a teacher to being a global energy consultant and data analyst. So it was a baptism by fire, but one that wasn't.
yeah.
Uh, it's my dad was a coal, oil, and gas attorney, so it wasn't
Mm,
like I was starting from absolute scratch. I had people that I could ask questions of, and really, it's those people over time. Both my first boss, Jim Truman, and the people that were clients and friends of family along the way that kind of taught me how the industry works.
mm,
And of course, now with the benefit of hindsight, I don't think I realized it at the time, but I was kind of learning how global trade is put together as well,
Mm.
without really realizing it. And of course, now that I know that, my perspective on its importance is a little different than it
Mm.
used to be. Let's just say.
I assume you still didn't stop, playing guitar, though.
No, no. In
But
fact,
yeah.
my band's called The Argument. We still put out music. We
Mm.
put out a new song last year. All of all of our records are available on Apple Music and
Mm.
Spotify. So if you search for The Argument on either of those platforms,
I
you
will
will
do
find
that
us.
afterwards. I'm pretty
Yeah.
curious about that.
Yeah,
Uh,
no, we're finishing another song as we speak. We played a reunion show last year. We have another one coming up on April 25th in our
mm,
hometown of Morgantown, West Virginia. So yeah, we're still playing. We just do
mm,
it, maybe once a year. And really, what we like to do was the creative side of it, was the writing and the
yeah.
recording and the arranging and that sort of stuff. Which oddly is this that sort of part of the creative process is the same thing I like about pulling together global trade data and then analyzing it
Mm,
and then writing that, because at the end of the day, you might not see the connection, but both of those professions tell stories to people who listen to it.
yeah.
So that's, to me, that's kind of the connection.
Mm. And getting back into the macro stuff now, before we go into the music industry. No, I'm joking. So let's talk about coking coal, right? So historically it was lumped in sort of with the thermal coal as in being dirty, and now both India and potentially Canada are labeling it as a critical mineral. I mean, the US has done it already. So does this designation change something about the capital flows, and perhaps also it as a political label, like the sort of perception of coking coal?
Right. It's a good question. I don't necessarily think it changes capital flows per se. Like, my sort of perception is the market capital will flow to where it is needed.
Mm.
It just depends. Sometimes in those dark corners of the market, they just have to shout really loudly, i.e., prices have
Yeah.
to go to the moon. But no, what it does is it changes access to capital
Mm.
for companies. So 4 years ago, 5 years ago, when I started, almost 6 years ago, geez, when I started getting active on Twitter, I'm at MF Warder there if anybody wants to follow, obviously.
Yeah.
Uh, the whole reason that I started to speak up about coal was the fact that it was, just it had become persona non grata amongst major investment banks. With the climate initiatives, they had, um, resolved to just not fund any more coal projects with
Mm.
the idea that they could just get rid of it, and well, you can't, because coal is not an end product. It is used to make things. It's used to either
Yeah.
generate power, or it is used to make steel. It serves as the reductant to reduce.
Yeah, you might be able to reduce it, but it's vital to the production process.
Yeah. So in any sort of transition away from fossil fuels would take time, but like, you have to future proof all of the technology that is associated with it, not
Mm.
just the fuel part. And the narrative had gotten so far ahead of itself that people were trying to go from step one to step 100 instead of going from step one to step two.
Mm.
And that's where you run into problems. When the unicorns and fairy dust is the basis for your projection, you're bound to come into a rude awakening, one way or the other. And of course,
Mm.
now, uh, especially after COVID, the world has sort of woken up to the idea that we can't depend on China for anything, because they're
Mm.
not, necessarily acting in the world's best interests. They're acting in their own best interests, which most countries should.
Yeah.
It's rational for them to do that. But it's kind of sent a light bulb through, in a bipartisan fashion, through the world, that these mined commodities,
Mm.
including coal, we need to pay much closer attention to going forward, because it is actually the mechanism by which the West can secure its own independence.
Mm. And we've seen these sort of the cyclicality in met coal prices and thermal prices, we've seen those crazy highs really of I think about $600 per ton, if
Mhm.
I recall that correctly. So where do you see sort of the marginal cost of production floor right now, and this sort of the 200 to 250 US dollar per ton range, the new normal, so to speak?
When I see when I last year the marginal cost of production was right around 165 to 175 dollars, and that's right about where coking coal prices bottomed out at. On
Mm,
the thermal coal side, it's different because each region has its own power market and can support differing power prices. They have different types of plants, so
mhm,
there's not one number that I can point to on the thermal side.
mhm,
But for the Asia Pacific region, for high CV thermal, that number's right around $95 $100 now, and for Europe for high calorific value, high heat thermal coal from the U.S. It's more about $90, 95 thereabouts.
mhm,
And if you add in say a 10% profit or something like that, that gets you kind of in the area where markets will have to kind of functionally bottom. They can't really go below that because if you start to shut in tons, you can't
yeah.
also increase demand at the same time. That's the lesson that we learned in 21 and 22, which I
Mm.
think the political powers that be have a much more visceral understanding now than they did 5 years ago.
Mhm. Mhm. I mean, everyone cites sort of these large targets for India in terms of steel capacity by
Mhm.
2030. I think it was around 300 million tons, if I
Yeah,
recall
that's the
that right.
stated goal. That's right.
Yeah.
Yeah.
And as a sort of analyst yourself running the sort of outlook for that market, is the global metco market actually prepared to sort of meet that demand? Like, where's the new supply supposed to come from? I mean, Canada is sort of, there's not much new coming really, and India seems while they want to sort of look for more assets, they still seem to be a little bit hesitant from what I've seen.
Well, the answer is it kind of depends, right? Just if you look at where India's production was last year, I think it was about 155 million tons of crude steel produced, and they want to get to, and their capacity is probably around 200 million tons right now. So they want
Mhm.
to increase capacity by 50%, which implies that you'll increase production by another 100 million tons or thereabouts. Um, if you just took that delta in and of itself, that implies you need another uh, you know 60 million tons of coking coal or thereabouts, which would in turn imply that you need another 20 million tons of premium low volatile met coal to provide the stability for that
Mhm.
production. But that's probably overstated. I think how that's going to wind up being expressed is a little differently. It's
Mhm.
first off, there's not enough coal. If that's what how India were choosing to solve that problem, no, there's not enough coal. Coal prices would go to infinity. There's not enough production that's coming to market that will be able to satisfy that demand uh, unless you take these measures. What measures I think they will take is I think they will increase PCI consumption, pulverized coal injection. So
Mhm.
that's a type of low volatile coal that doesn't coke necessarily, but it is very high heat thermal
Mhm.
coal that is pulverized and then blasted out in tuyeres uh, for both the carbon that's
Mhm.
contained within it and as a fuel.
Just
So
sorry to intervene. Just to sort of add to that, that would decrease the quality of the steel, right? As far as I understand. I mean,
no,
I don't have a no,
no.
no.
Uh, No, you can inject a pretty fair amount of PCI. I mean,
Mm-hmm.
Europe and Japan have the highest rates. Let me see where they are. Europe and Japan both inject in excess of, call it 180 to 220 kilograms of PCI per ton of hot metal,
Mm-hmm.
and you can even push it a little bit beyond that. But India right now, like the older furnaces, are more like 120 to 150.
Mm-hmm.
So I think the PCI rates in India will increase over time. and I think they'll use a lot of what we call stamp charging. Uh,
Mm-hmm.
China, I want to say about 75% of China's Coke is stamp charged. You can imagine like a big, it's like a big press, right? So you
Mm-hmm.
can use a lot of lower quality coking coals in a stamp charged oven, and you can add pressure, and of course at a higher cost. That takes energy, and that takes, other. It has other costs attached to it, but you can use lower quality materials to make the coke. And so instead of seeing, a 40 to 60 million ton increase in thermal coal, I think probably what we're going to see is like plus 10 to 20, 15 to
Mm-hmm.
20, something like that, million tons of coking coal, which implies about, another 5 million tons of premium low volatile coal,
Mm-hmm.
which
And,
which we'll touch on later. So that sounds a lot easier,
mhm,
but when you look at 2030 and you realize that premium low volatile coking coal production is going down, well, that's where I think, by the
mhm,
time we get to the end of the decade, that shortage of premium coal
mhm,
will be pretty visceral. So at the same time, we have to keep in mind that China's production is also going down on the steel side.
mhm,
So if China, I think they'll decline somewhere between 5 to 10 million tons. India's going up something like, you know 10, 15, 20. So those two are kind of going to offset. We should also have some increases in Europe, I think, as Europe kind of works its way out of the economic doldrums it has been in
mhm,
for a number of years. I think you'll see steel production there rebound to some degree. And then, also we have to probably at this time think that Ukraine is going to rebuild as well, and that will require a lot of steel.
mhm.
So like
And
those
yeah.
are the dynamics really that are taking place, and then everywhere else we kind of look at is relatively flat,
Mhm,
over that same period of time. But those are the countries that are changing.
mhm. And would you say that sort of the market is sort of underpricing the longevity of met coal demand? Like, how do you see this? Because we still see some, predominantly in Asia, blast furnace build out is still being prioritized way over other substitutes.
Yeah, in China, that's going the other direction. China's industry is old enough now that its scrap industry will begin to take shape, and they'll start to convert more over to electric arc furnace production
Mhm,
as more scrap becomes available. In addition to just their economy slowing down, and they need less steel to make cars and less steel to make white goods and those kinds of things that typically rely on blast furnace steel. Um, so it's a quid pro quo. It's a balance
mhm,
between a growing India, a slowing China, and the rest of the world that is comparatively flat. So it kind of just depends.
mhm. So at the end, they might all balance each other out in a way. So yeah,
Yeah,
I
it's
think.
like yeah. If I look at global coking coal demand, like the countries that are growing, like we're talking about overall, a plus. Let's see, net gain up somewhere between 8 million tons to 25 million tons, depending on how things progress in
Mhm,
India, Indonesia, Vietnam, Malaysia, and how much China declines.
mhm, mhm,
And that's going to be split up between, again, there's going to be a lot of, second tier hard coking coals, PCI, those types of coals that will be demanded. But we're still going to need to see an increase in, premium low volatile, you know, uh, strengthening coals
mhm,
uh, to uh, to be produced over that period of time. At least somewhere between 2 to 4, 5 million tons or thereabouts.
mhm. And my Substack is sort of about stocks and finding opportunities within markets. So as an analyst and looking also at the macro as well as the micro, which sort of specific coal producers, be it thermal or met coal, and also rare earth element stocks do you find, let's say, interesting, appealing, or perhaps undervalued, whatever criteria
Okay,
fit?
that's a long question. Let's start with
Mm,
coal, and we should probably separate out rare earths into another vertical of a
mm,
conversation. The themes are similar for it. but it's just a different circumstance altogether. On the coal side, the dynamics that I'm talking about in met coal are pretty well set in stone at this point. There's not a lot of
Mm.
production, if any, that's coming on online. In fact, some mines are set to deplete. We'll get some restarts over time, but that's just replacement for what
Yeah,
should have been
it's
there in the first
already
place.
yeah.
Right. So, it's going to be a tight market from here going forward, and as much premium coal as anybody can produce, the market will accept. So, for those coals, I don't think we're going to get back to the Russia Ukraine fueled highs of 2022, which got up to around $600 a ton for both thermal and met.
Mm.
For met, I think the top of the market this time around is probably going to be. I think we'll see a three handle again. At the next, certainly at the next, supply constraint. Probably we might spike and see another 400 handle at some point in time at the peak of the market.
Mm.
But by and large, I think we'll probably wind up averaging about 250 to 275 over the course of these next 5 years. And if the market moves the way we draw it in terms of just supply and demand, it should kind of move up and to the right at a 10-20 degree angle. Thermal coal is a lot different. Thermal coal is really dependent on the build out of global LNG supply and the pace at which um, countries need to increase their power demand, which at this point is largely globally driven by the race to increase artificial intelligence compute.
Mm.
That's
And perhaps in some regions also independence in some ways, like
yeah,
being
well,
independent. Yeah.
yeah, that's true. But as long as gas is there to supply the market, then the upside for thermal coal is limited by gas itself. So
Mm.
if there's enough supply of gas, then thermal coal should stay, within kind of a floor of call it $95 to $100, depending on the region. I think the next spike we'll probably see 175, 200 maybe.
Mm.
When we get into if we get into a serious supply constraint at some point.
Mm. And I guess now it's earnings season. Like, is there
Mhm.
perhaps a stock which you're like looking forward to see the
Yeah,
results and how
yeah.
they turn out?
Yeah, so that kind of leads us into the equity discussion. I mean,
Mm. Yeah.
given that backdrop, I'm a little bit more optimistic still about the met coal side of things than the thermal coal side of things. For one, it's definitely constrained, without a doubt,
Mm.
and the competing fuels for it, which are really recycling, which is going to take place in China but not in India, at least not at this stage of things, and uh, and green hydrogen, an alternative
Hmm.
reductant. I think natural gas and DRI is going to displace perhaps some, blast furnace production, but I think the hydrogen conversation is probably dead in the water at this point.
Mm.
I'm sure we'll revisit it at some point over the course of the next decade, but the prior projections that we'd see, green hydrogen eating into coking coal demand were largely, I think, over exaggerated. So for me, the met coal story is a little bit more where it's at.
Hmm.
Um, in the current environment, I prefer in a ramping environment, I would prefer the U.S. equities over the Australian equities.
So like
Uh,
Pia Body, for example, Alpha
and then that's
Metallurgical
uh,
Resources. I mean, there's a few.
I think we need to name Warrior Met Coal first, as they're
Hmm.
growing production into this part of the cycle.
Yeah.
It's unclear what kind of shareholder return program they're going to institute, but they're uh, they're done building out the Blue Creek mine. So HCC is going to be, I think, a key holding for most people who are
Mm.
following coal markets. AMR is going to fare well as well, but they're going to fare much better as prices ramp up and increase. So AMR is by far the highest beta coal producers.
Mm.
So they're the ones that you want to play when coal prices are ramping up exponentially, because they'll be the ones to be able to capitalize on that, at scale more easily than others. Um, and then I think we have to talk about Ramaco Resources.
Hmm.
which basically I want to be invested in anybody who's producing low vol.
Yeah.
Ramaco has about half low vol, half high vol production, about 4 million tons a year, maybe a little bit less low vol.
Mm.
Um, and uh, and then we have to talk about Peabody BTU. They're bringing on the Centurion mine, which will increase PLV supply. This is really the only uh, you know supply that's coming online here over the next
Wow.
5 years
Yeah.
that will actually increase low volatile tons into the market. So, that's really going to increase their cash flow. It's going to be about 4 million tons a year ish of premium low volatile coal at a point in time where the cycle's ramping up. And now that their merger with Anglo is in the rearview mirror and they're not going through with it, I think they're going to have more money to allocate towards buybacks. So
Mm.
now we're actually to a point where perhaps Peabody can really get things moving.
Mm.
Um, my largest position at the moment is half met, half thermal. It's core natural resources,
Hmm.
and the reasoning there is
CNR, right? I think is the ticker.
CNR. That's right.
Yeah.
They also have a buyback program on, but the reason that's my largest position is I think that'll be less volatile going forward.
Hmm.
So it's one that I can just hold and not really worry about it too much.
Yeah. Like a
And
steady compounder in some ways,
Yeah,
steady
so
mover.
on the thermal side, it's going to benefit from higher U.S. prices domestically, and also it sets the floor for the European API2 market. API2 is the coal spec that we use
Mm.
to track. You can see it, read it on bar chart. They call it Rotterdam coal. Um, so CNR makes pretty good amount of money from its thermal exports. The tune of about $300 million free cash flow per year that they use toward the buyback. And then their Met side, which is the used to be Arch Resources,
Mm, yeah.
is I basically look at as a call option on higher met coal prices. They have a
Hmm.
lot of high volatile production, so kind of lower quality material relative to PLV, but it's still very good, and they're very low cost operations. And when those operations actually get moving, and really contributing to the bottom line, I think CNR is going to have a ton of beta that to catch up with it there.
Mm. And you don't find the sort of Australian equities also interesting? Like Whitehaven is one of the more prominent examples in this. Like, do you see any sort of things that perhaps you don't
Whitehaven,
like, or
well,
yeah?
Whitehaven is like the Australian CNR, right? They have a
Mm.
great thermal coal business, which kind of anchors the company, and now they have two large met mines that produce, kind of lower quality met coal, but at these fantastic margins as well. So
Mhm.
yeah, Whitehaven is sort of the Australian equivalent. I don't own as much of it right now because, well, A, I can only own so many,
Yeah.
but also B, as an American citizen, I can't take full advantage of the franking credits like an Australian citizen would. So,
Mm.
there's a little bit of back and forth there. But I mean, all of the Australian equities are going to do well as well. So
Mm.
I don't want it to mean like I'm picking favorites here. The limiting factor for Australian met coal companies, I also own Stanmore Resources, for instance,
Mm.
is two things really. One is where's the Australian dollar going to sit? Um, as if the Australian dollar appreciates, if we're really going to torch the dollar here in the states, that actually increases mining costs for Australian companies and
Mhm.
raises the global cost curve. But at the same time, it reduces the royalties that Queensland collects, which, as we get to these super high prices, basically just turn into a vacuum and hoover up a lot of the margin that those companies would otherwise make. So, an appreciating Australian dollar, it does increase mining costs, it does increase prices, but it also, potentially keeps the government's hands out of their pockets as well. So,
Mhm.
I'm not somebody who can forecast what a currency is going to trade at. So I'm a consumer of that data rather than a generator of it. It's path dependent. If the Australian dollar stays where it is, point
Yeah,
six
I
five
mean, it's dependent on
seven,
so many factors, macro, real interest rates, so many
yeah,
things. Yes.
if it stays where it's at and the Queensland royalty regime stays in place, as prices go up to 300, 400, US dollars, which would be five, 600 Australian dollars, the government's going to take a lot of that money, whereas the U.S.
Mm,
will remain unfettered. So that's my rationale for preferring the U.S. stocks over the Australian stocks. Now at low
would you?
prices,
Mhm.
it's a wash,
Yeah.
one or the other.
Would you sort of say that also, with the administration change, that now at least coal and met coal is, at least from that perspective, politically speaking, more favorable in the US than, let's say, in Australia from that sort of perspective, or would you say there is no change at
Uh,
all?
to some degree, I mean, amongst the political opinions, I don't really think a whole lot has changed. But the broad willingness to support mining is I think really the what has is the biggest difference between say 2021 and now. Like the that 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 train has left the station, and
Mm,
you can't close Pandora's box. I'm running out of cliches to
yeah.
describe it. But that's I don't think we're going back to a time where it's going to be much harder to mine, and whether that's uh, critical minerals or
Mm,
metallurgical coal or thermal coal. I think we're going to see the brakes get eased off of on on the opposing side of the political aisle. So I think it's
mm.
more palatable is not how I would describe it, but less less contentious, let's say.
Mhm. I mean, it's sort of important for the U.S. supply chain. So they're really trying to, at least sort of narrative-wise, trying to push it. So would you say there has been some sort of like real willingness to really push ahead with rare earths elements, and perhaps also some stocks you find interesting in that regard? That yeah.
Sure. I mean, the rare earths have really been kind of what set off, this realization that, well, maybe we need
Mm,
uh, a lot of this material. Um, but as many people have often quipped, rare earths really aren't that rare. I mean, there are a lot of deposits; they just don't drive primary mine economics. So you have to extract something else in order to get at them. And I think the other piece of information that people are realizing now. I mean, I went to a critical minerals conference in DC in December, and Senator
I assume
Hickenlooper.
the sentiment was great there with the
Yeah,
recent
well,
performance of these
you know,
stocks.
yeah, I mean, there were a couple of politicians there that only paid lip service to the industry, but there's a panel with Senator Hickenlooper from Colorado, who's a Democrat, Senator Todd Young from Indiana, who's a Republican,
Mm,
talking about the need domestically for a lot more heavy rare earths. They singled out yttrium, they singled out samarium, some of these ytterbium, some of these other heavier materials that we don't really have in abundance in the U.S. They signaled also that we don't just need the material, but we
mm.
also need the ability to process it into these downstream uh, either magnets
Yeah, I
or
mean,
other.
China has a monopoly there pretty much when it comes to processing.
That's
Uh,
right. So
mm,
so now I think everybody is starting to realize that we've kind of solved the oxide situation. We can either produce neodymium and dysprosium at MP Materials in Mountain Pass, honestly we could probably supply about 100% of U.S. demand for NdPr domestically.
mm,
But those heavier minerals, if the USA Rare Earths Round Top mine in Texas, isn't doesn't outperform expectations, we're going to have to import some of that feedstock, and we can do that from some of the Brazilian ionic clay producers or some other there. But what we need to do is we need to build either solvent extraction and metallization capacity in the United States
mm,
or in friendly shore countries, and also downstream magnet manufacturing. And we don't really have the skill set to do that because we haven't done it in 40 years.
mm.
That's not a skill set that you can just go to college for anymore. come out of a magnet manufacturer. Like it's a really specialized bit of knowledge that we're going to have to recultivate after letting it lay fallow for a number of years.
Mm,
So the stocks that we cover on the rare earths publication that we write, which is the rareearthstrader.substack.com. Most of the ones are focused on metallization, solvent
mhm.
extraction, those types of things, and
So
those
sort of
processes.
picks and shovels plays instead of
Yeah, I
you
mean,
know.
there's some, on the production side, MP Materials, Linus Rare Earths,
Mm,
um, uh, uh, Iluka Resources is another one. Those companies are going to do fine. The U.S. just made a deal with Serra Verde
mm,
pretty recently, um, and but the real winners are the ones who are going to be sitting where the bottlenecks are, and the bottleneck is right in metallization. So companies like uh, I'm trying to think, USA Rare Earths. It is one that did buy a company called Less Common Metals.
mm,
So they have that technology now. It's
mm.
contained within that company, and should they choose to deploy that in the U.S., I think they'll find a lot of funding. But there's another company called the ticker right now is just BLBX, Black Box Stocks, but
Mhm.
they have a company as well that does that works on the metallization side. It's really interesting. Um,
Yeah, very interesting because I also haven't like I'm not familiar with these sort of picks and shovels plays. I didn't really look into them that deeply. So it's an interesting sort of way to look at rare earths. And you know, in looking at all of these sort of resources, rare earths, and all of this, what would you say sort of the best risk reward, perhaps when we're talking about from the macro level, right? As just the commodity speaking, like because rare earths recently, you could say it's been a bit euphoric in a sense. Maybe you see it differently, but yeah.
Best risk reward from here. That's pretty interesting. Um, I would probably say this is contingent upon where these stock prices are today.
Yeah,
Uh,
yeah, that's
so take into context whenever you're watching this that this is as of February 10th. I think probably the best risk reward is it's probably Ucore Rare Metals relative to now. Um, the I would say normally black box stocks, BLBX, which had did a reverse merger with a company called Realloys.
mm.
But we recommended that in October, and it's up 100% since.
Yeah.
So
Yeah.
it's done very well. I think so. From here, I think it's probably Ucore. That so the deal that we just signed with the Brazilian rare earth producer
Mm,
is going to have to be processed somewhere in the U.S. And I think their facility in Louisiana is going to be the benefactor of that. So and it's down. I mean, today it happens to be down 5% because it was up a whole bunch.
mm,
Uh, post that announcement. So risk reward right now, I think that's probably the biggest one. But if and anytime MP corrects by a lot, or Linus, or energy fuels, in my mind, those are opportunities to get in for the longer haul.
mm.
First off, those stocks are all going to do well whenever small caps, high beta stocks do well, and whenever rare
Which
earths,
right now is sort of the time for it. I mean, we're
yeah,
nearing the end, possibly in the next 2 years, in the bull cycle, at least
yeah.
from.
Well, I mean, when during periods where GDP is accelerating, and inflation is either accelerating alongside it or slowing down.
Mm,
As long as GDP is moving up, those stocks are going to do well. And then the other time is when they catch fire in the news cycle.
mm,
So whenever a deal gets done, or wherever whenever it sort of picks up, just I mean, look at Google Trends and see uh,
Yeah, yeah. You can
reduce that.
probably see an explosion for the
Yeah,
rare
I
earth
mean,
part. Yeah.
reduce the numbers down to Z scores, and when it
Mm,
starts to move, two standard deviations in the lower direction, it's getting ready to cycle back up again.
mm.
It usually
I
takes
guess
about.
we might be there soon with the standard deviation being a tool, or
I mean, it's
yeah.
been coming out in the news about every 2 to 3 months.
Mm,
It's hit pretty steadily.
mm.
But again, that's only going to work, as long as GDP is rising. I'm not sure how much longer we have, how much longer we can juice the orange on that
Mm.
one.
I'm just curious, you sort of tied to GDP. I never had that sort of perspective being mentioned before. Can you just like introduce why that plays a part with the rare earth element?
It's not. It doesn't necessarily have to do with rare earths. It just has to do with there's more money in the system that will get distributed over a finite amount of equities
Mm.
in the market. So when there's more money coming into the market, the value of everything rises. That's the only overarching sort of principle
Yeah,
for
I
it.
mean, there's this one theory out there. I forgot from the 19th century or something. I know I know which one you mean. Sort of the ones being closest to the money printers, which is in this sense sort of equities. They
Mhm.
profit the most from it, and it was very interesting really talking to you about this stuff. Is there sort of anything you want to mention before we end this interview? Anything sort of?
Well, sure. First off, we write about this stuff every day, even if it's
Mm,
just price action within the market or talking about, these stocks. You can read my stuff at thecoaltrader.com or thecoaltrader.substack.com. You can read on the rare earth side at the rareearthstrader.substack.com. You can follow me on Twitter at mfwarder. And, honestly, I'd say, if you want to learn more about, the either the sector or mining in general, or how sort of all these ideas start to fit together, join up on the Substack. I put out a lot of free material both in our chat,
mm,
and we put out a lot of free articles as well. We always answer questions. I try to be as active on those chats as I possibly can, because at the end of the day, like the reason I started to speak up about these industries is because nobody really had anyone to talk to or to ask questions of, and the more that people are aware that us in the mining sector and our various levels of expertise, just how important these commodities are to the world, the more kind of the better informed everybody's going to be.
mm,
And that's really what the goal is on my end. It's the more we all know, the better these companies will do. The more jobs they can support. Both in whether it's my home state of West Virginia or for my friends down under in Australia. Like that's it supports jobs. It supports the participation of capital in those markets as well,
mm,
and all of those things are really necessary to have a robust global economy. And this is just our little corner of the world, and we'll do what we can to sort of advocate
yeah.
for it and make sure that we can function as unfettered as we can.
Mm. Well, really, thank you, Matthew, for the opportunity to talk with you about this and really get a sort of perspective on the general macro and as well micro level. So, really, thank you for the opportunity here, and it was really great. I appreciate it. Yeah.
Well, thanks, Lucas. Happy to do it anytime. Hope there's less time between this one and the next one
Yeah,
than there is.
that was a bit long, wasn't it?
It's okay. It's
Yeah,
okay. It was
yeah,
last year was pretty boring. This year's much better.
yeah. Yeah, I mean the medical prices was just flatlining.
That's right. Much more
Yeah.
exciting now, and I think we will have a pretty exciting 2 or 3 years here. So,
Mm. Yeah. Thank you again.
my pleasure.